As we approach the end of 2024, we intend to spend the next few episodes of the Investor Insight series taking a step back and assessing the implications of what has been a highly eventful last 12 months for the global economy. In a year with numerous elections around the world, many of which bringing in a change of power in their respective jurisdictions, and central banks commencing a pivot towards easing measures following a period of inflation-controlling tightening, we will be speaking to several market strategists and economists from within some of the largest asset management groups to discuss the macro and some of the key top-down considerations that these teams are currently digesting and feeding into the outlook of their respective underlying portfolio managers as we move into 2025. For the first of these, we were delighted to be joined by Carsten Roemheld, capital market strategist at Fidelity. Welcome to the Investor Insights podcast, hosted by Killick & Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killick & Co YouTube channel, or by searching for Killick & Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killick.com. Killick & Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan, and invest. And you can find more details on the unique ways in which we do that at our website, killick.com. In today's episode, we were joined by Carsten Roemheld, who started his career in 1998 and has held positions in both the financial buy side at Cominvest and sell side at Credit Suisse, before joining Fidelity in 2014. In a slight departure from the normal episodes in the Investor Insight series, which usually features portfolio managers, Carsten is a capital market strategist and works closely with various macro, economic, asset class heads and regional specialists at Fidelity to provide top-down analysis for various stakeholders of the company. This will likely be the final episode of the year for us on the Investor Insights series as we take a short break for Christmas. But as we line up a range of interesting speakers for early in 2025, we would gratefully receive any feedback on the series so far. And of course, please let us know if you have any suggestions for topics you'd like us to cover in future episodes. As always, do get in touch if you have any questions or would like any further information on any of the topics discussed in this conversation. Carsten, good afternoon. Thank you so much for sparing some time today. How are you doing?
Very well. Thanks a lot, Gordon, for inviting me.
So, Carsten, we've got this kind of standard opening question on these discussions. And what it aims to do is kind of get a bit of an insight into you and how you kind of go about your work. And so I wondered, kind of recording this in the middle of December, so kind of approaching the end of the year, I wondered if there was an anecdote from a kind of recent meeting or a meeting you've had this year, or a kind of research project you've been doing, or just a book recommendation or article or something like that. Anything you could share just to give us a bit of an insight into you.
Sure. What comes to mind here is that I'm doing some podcasts and webcasts for my clients as well. And in preparing them for the year end, I was thinking about something that, I want to do for next year. And, I'm always trying to provide some thinking outside the box, or something that clients might not have on their radar screens and so on. And I've come across the list of surprises, it's called, by Byron Wien. I think that's been published since the 80s or 90s and so on. And I really love that concept because it's supposed to look for some tail risks, some things that people have not on their minds, but it's worth considering by investors. And so, looking at that, I was trying to think about some scenarios which might not be on people's minds for next year, and try to come up with some questions. And I put them to my audience, something like, what happens if Trump decides to have a Bitcoin reserve, or what happens if treasuries go to 6%, or what happens if Nvidia doubles again from here, and things like that. So I really like preparing that, because thinking, not along the consensus lines, but along something else that is worth considering. And that was really, I was having a lot of fun in preparing that.
Yeah, no, I bet. Yeah, no, definitely worth thinking about some of those tail risks. We might come on to that a bit later on, but yeah, no, it's certainly useful. Um, Carl, so what I thought we'd do with these conversations is obviously a slightly different format to our kind of usual. We're talking to kind of portfolio managers usually, but what I thought I'd do is I kind of split the conversation up into kind of three main parts, I guess. I thought first off, kind of trying to tackle that economic backdrop. Then perhaps second off, kind of look at what the implications are for the market itself, and then maybe we'll finish off if there's time with some kind of quick fire questions on a few different areas, things like tail risks. Perhaps we'll come back to that. So if we start with the kind of the economic outlook, and maybe start with the US, because I mean clearly the big story of the year has been the election and just how strong that Republican showing with the clean sweep was. Could I ask you, I know it's a huge topic, but could I ask you to kind of run through how you think the economic outlook has changed in the US since the election?
Yeah, sure. So I think the sweep was a surprise, but not the victory of Trump himself, basically. But still, if you look at the House, majority, it's only 2 seats now, so it's come in a bit less dominant as expected. But still, the sweep is obviously relevant for the U.S. outlook, and it means that Trump can govern through basically, and has the support of the Congress with him. So I think the narrative has changed a little bit after the elections in terms of, some positive growth assumptions. You see a lot of expectations that have been revised up for the US after being already revised up for this year. So it looks quite strong. And I think it's based on the deregulation and on the tax outlook for what Trump is going to imply. So for deregulation, it's a clear case. I think that should be beneficial for the US companies. The tax effect that will only kick in 2026, I think, when the new regime can be introduced. So for this year or for next year, basically, it's not going to have that effect. But the effect altogether is not as significant as it was in 2016 when the corporate tax was reduced from 35% to 21. So that's a much bigger leap than it is from 21 to 15, so to speak. But the tariffs, that is the thing that's a lot harder to actually assess. And to see it positively for US markets because if they were to be introduced as aggressively as Trump has indicated them, then you could expect a slowdown in global trade altogether for everyone, right? And then you can expect some retaliatory measures. So the US is in a pretty good situation to go in the negotiations like that, but it would hurt basically everyone. But it's a bit of uncertainty around how high and broad the tariffs are going to be and when they're being introduced. He can do that as a president without the Congress, basically by executive orders. But I think what lies behind this a bit more is some kind of bargaining power for him for negotiations of any kind. So Trump could try to push through for the European states to increase their defense spending to the levels that are necessary. He could try to get some deal with China about imports and exports so that the US gets what they need, but also make sure that the local companies in the US do not have to face competition from other low-cost Chinese producers. And he could force other countries like Canada or whatever to close their borders and to allow less immigrants into the US. So it much rather seems like a negotiation tool for him than something that he just wants to completely introduce for the long term. So to answer, I think the picture is a bit muddy, if you want. I think the what the market has priced in is a bit more positive, and it has been very quickly to price that in. I think if the tariffs are more aggressive than anticipated, then it could be detrimental for growth numbers altogether. But it still means a better situation for the US than the rest of the world, because I think they have a very strong situation to go into those negotiations. And then again, if you compare it to 2016, I think then markets were a lot more muted. Growth was a lot weaker before that. So the effect of Trump coming in was larger. And therefore, I think the equity market leap was probably a bit more aggressive. Now, I think the delta basically on top is not that great. So maybe markets have anticipated a lot of that positive outcome already from the elections.
Yeah, no, some important points in there. Yeah, lots of people kind of comparing to the last term, but we are in a kind of we're in a different economic environment now. I mean, rates are obviously a lot higher, inflation's a kind of different picture as well. So yeah, some important points. Thank you for that. I mean, you mentioned the kind of rest of the world in that. I mean, reading through some of your team's kind of outlook papers, which obviously you're doing a lot of publishing a lot of work at the moment. It's kind of that time of year for the kind of outlook reports. But one of the key messages that I certainly took from some of that work was the potential for divergence or perhaps continued divergence of policies, economic performance from the US and other regions. Could you maybe talk us through the primary factors that you're considering with kind of Europe, China, and what the outlook looks like for them?
Of course. So the divergence is twofold, basically. So on a growth basis, I think US is most beneficiary for these measures that Trump has introduced, and Europe is probably the most sensitive to these measures in a negative way, because free global trade and multilateral trade, basically, that has meant that has supported Europe the most in the past time. So globalization has been, perfect for Europe, introducing or getting, cheap commodities and pre-products in there, and then exporting higher valued goods into the world. So if trade in any way is restricted or is under tariffs, also Europe is probably suffering the most. And therefore, it's the biggest problem for Europe. China is also obviously quite dependent on US trade, because China has been very weak in domestic terms right now because of the problem in property markets, and therefore domestic consumption has been very weak. China, to remember that China is planning to go on a path where exports play a lot less of a role with regards to their economy going forward than they have in the past. So they really want to get to a consumption economy as well, maybe similar to the US, with the majority of the growth being basically done by domestic consumption. But as the consumption now is lacking because people are saving money, they're really worried about the property market. They still have to find their fate in goods exports, and so they're flooding the market, the global market, with electric vehicles, with technology, with electronics, and all that. So they are much more dependent on exports once again. And if this is restricted by the US again, and if tariffs get higher versus China, that's another problem. So China and Europe basically are more dependent on each other going forward, and therefore they have to make sure that growth comes up again, and China has to find some way of, getting that trajectory in a positive way once again. So they have to really tackle this property problem by introducing more stimulative measures. I think they wanted to wait until after the Trump election, and maybe now even after the inauguration, to see what the real measures are, what is being introduced, and therefore to be able to react specifically to that. So the outlook is much more muted, I think, for Europe. But then again, I think maybe rate policy is different, because Europe has weaker growth and maybe more disinflationary impacts going forward, because of all the overcapacity in the rest of the world is now looking for new homes. So you can expect the ECB probably to lower rates even more aggressively from here, and that's the only hope basically for Europe in some ways to come onto a good path going forward.
Yeah, no, some interesting points there. Thank you. Maybe let's move on to the markets themselves and let's start with equities. I mean, it's been a year where you've had that kind of continued market concentration with whether it be kind of large caps or particularly large cap technology businesses doing incredibly well. And you kind of talked us through that kind of that divergence in kind of outlooks for US and Europe. I wondered, just given we've had some of this move into kind of valuation multiples being extended in the US, for example. I mean, what implications do you see for that economic backdrop that you've just laid out for markets as we stand today?
I think the large caps have performed best everywhere, probably not in the US only, but in other jurisdictions as well. But in the US, it has been much more visible, so to speak, by these extremely high multiples and by these huge market caps, these mega cap tech companies that have really shifted the whole valuation level from the whole market up a lot. And I think that's due to earnings growth. And I think the most important driver for equity markets is still earnings growth. And it has been superior for the last few years, with those guys producing somewhat in a 35, 40% growth rates. But that, I think those growth rates are limited in time, and that can't be repeated forever, because you get into a situation now where, maybe we get into a higher inflation regime once again. Maybe the support from interest rates from the Fed is not as high. And of course, the earnings growth itself is slowing down. You can see, if you look at the US market, expectations for earnings growth for these mega cap tech companies are coming back, are reducing to a bit more levels around, I don't know, 20, 30% max or so. And for the rest of the market to come up. So the market altogether should broaden out, but it also means that the valuations levels shouldn't be that high, because they have reflected those higher growth numbers. And now, when growth is slowing down, and we might get another impact from those tariffs in some ways for earnings growth, then you have to be a bit more cautious. And therefore, I think this dominance of these super caps in terms of their super high valuation multiples is coming to an end in some ways. And maybe the AI cycle is also hitting a pause into next year. So I think other parts of the market are more attractive right now. And looking beyond the index level, you can find a lot of companies that are really attractively valued for the growth rates. For example, the mid cap region in the US has a similar earnings per share outlook than the large caps, but a lot lower valuations in that regard. So I think that is the things that you have to look at. And now I think this year we had the benefit, earnings growth was going up and valuations were going up. But I think as we look into next year, the valuation levels will not be the same support as they have been, and so we can expect probably some contraction in valuation in terms. And therefore, I think you have to be a bit more defensive. You have to look in different regions. Beta is, I think, not the place where you get most returns going forward. I think it's more alpha. It's more looking at these specific opportunities in certain markets, which might have been under the radar in the last 2, 3 years when it was all dominated by the mega caps. But that will be becoming much more interesting going forward.
Yeah, no, we've certainly heard that from a number of the portfolio managers that we've actually had on the series, that kind of broadening out opportunities kind of in some of the mid cap or smaller cap areas of the markets. That certainly corresponds. Um, Maybe let's move on, kind of whistle stop tour of markets here, but kind of fixed income or and kind of credit. I mean, talked a little bit about kind of inflation, but could I maybe ask you to kind of talk through the inflation outlook? Clearly, some of Trump's policies are reflationary as well. Things like the immigration, if that were to come through, has implications for inflation. But could I ask you to talk through the inflation outlook and perhaps current expectations for interest rates? Just kind of key considerations that you're looking at that obviously have an impact on all markets, but fixed income and credit as well.
Yeah, I think the inflation outlook is hugely relevant going forward. And that is also where the divergence comes in, because if you look at Trump's policies, and as I said, there's a lot of uncertainty around this right now. But if you look through it, and if you take these things for granted now, then inflation in the US is probably unavoidable. So basically, we have come back from very high single-digit numbers in inflation now to more reasonable numbers around the 2, 3% mark. And that was a good way down. But now, as we are expecting more policies that go towards an inflationary path, as you said, the trade tariffs is one thing. Then the obviously immigration is another thing, where we could lose some of the workforce in the US, and therefore pushing labor costs up as well. Um, and these things are inflationary. So I think the outlook for the US has become more inflationary, and therefore the Fed is in a very difficult situation, as they have been on a downward trajectory this year and have planned to cut much more going forward, as at least according to what the market had expected. I think that scenario is now undermined, and we can expect much less of cuts and rather some pauses going forward, because they have to make sure that they are still heading towards the neutral rates. But if we get a more inflationary push going forward, that could be counter to that. But on the other hand, like other markets like Europe, for example, they have a maybe more disinflationary outlook. And therefore, as I said before, the ECB might be cutting rates more aggressively. So that's also the divergence coming into play, which is very unusual because Western markets historically have tended to trade together in central bank policy terms, but that seems to be going a little bit out, and then that seems to be not the case going forward. So that means um, the Fed rates on the short end could not fall as much as expected, and then on the long end, I think that's also something that's quite interesting because if you look at whatever Trump is planning, it looks like it's very deficitary. In some ways, it increases the deficit, and when he wants to make tax cuts and things like that, all the tariffs would not be able to pay for all of that. So I think there's still something that needs to be financed. And that means, more supply, more financing required, more supply of US treasuries, and maybe the long end is still somewhat at risk at going higher in terms of yields. But in Europe, the rate outlook is more attractive. We have a weaker economic path, but the path to lower rates is clearer, and so it's a more defensive stance overall for government bonds. I think the European outlook is more attractive than the US market outlook. And if I look at the credit markets, spreads have compressed pretty significantly almost everywhere except in Asia, where I think the scenario is still attractive. We like Asia investment grade. We like Asia high yield bonds. They have spreads over 500 basis points at the moment. So it seems almost the only region where you get compensated for the risks taken. Not in Europe so much, not in the US, where spreads have compressed to all-time lows basically, and investment grade is similar. The only one which we would see a bit more positively is maybe US investment grade, which is somewhat a hedge against recession risks, which might come into play. And nobody's talking really about a recession, but if those policies are more aggressive than anticipated, and if inflation is coming up, and if the Fed has to be very aggressive, this could lead to an inflationary picture and to recessionary scenarios. That is the one hedge that we would make in the credit markets. But otherwise, it looks pretty stretched at these points.
Yeah, yeah, no, thank you for that. Um, Carsten, we've got a bit of time at the end. I wondered if I could maybe challenge you with a few kind of quick fire questions, if I may. And I mean, it's always very difficult trying to kind of predict things for the next kind of 12 months. But I wondered if there was if there was one kind of least consensus view that you and the team had at the moment. You talked through kind of a lot of the things that the market's talking about, and kind of early market reactions to things like the election. But if there was kind of one view that you had that you think the market is not appreciating at the moment, what would that be?
It's very hard to do that right now because as I said, that is the thing that worries me most about the market outlooks right now. It's that it's pretty consensus and it's pretty broad. So I think as when you think about how the market is positioned, and if investors are really positioned accordingly, then any deviation from that narrative can lead to rather violent moves in positioning as well. So as I said, we are somewhat defensive and try to position for some recession risks that are not on the horizon to be seen. So on the tail end, I think inflation hedges are something that you should consider definitely in the portfolio. And I think, gold is still an interesting play, I believe. So as a kind of an addition to a diversified portfolio, because it moves very differently to other asset classes, and it had shown. It was quite fascinating to see this year because gold has outperformed equities and still had a negative correlation to equities, which is quite unusual. So I think as an asset class, it's been quite interesting to add that to the portfolio. But other than that, I think we are still a bit constructive on China, which obviously requires a bit more patience there because there might be some things that need to be announced going forward, and maybe we have to wait until Trump has basically done his first action, so to speak. But we could probably expect some more stimulus versus the property market, or for the property market, which would then turn the sentiment a bit more in China. I think sentiment is still very bad, even after the quick September move that we've seen. But ever since then, everything has been a bit more disappointing, and people have said, "Oh, yeah, maybe that was more hope than realism." But I think they've addressed the situation, and they realize that they have to stabilize the property market to stabilize investor confidence once again. And I think if they introduce a bit more measures, a lot of money could flow back into China. That could be the one wild card for next year that could become very positive.
Yeah. Carsten, if I was to push you for a kind of area of the market where you have kind of particularly high conviction in the moment, maybe an area that's kind of got that valuation support, but also kind of outlook support to it. Is there a kind of asset class or an area or strategy that you point to? Again, a tricky question, but
Yeah. I would mention two areas, and one is more consensus, and the other one maybe a bit less consensus. The more consensus one is U.S. mid caps. I have mentioned before. I think the U.S. altogether is in a pretty good situation where we are still seeing, GDP growth revisions on the upside, and so depending on, as I said, the measures that Trump are introducing, then the market is supported quite okay. The mid caps have not reacted in the same way as the small caps have, and maybe as the large caps have. And their earnings growth potential for next year is as good as the large caps, but the valuation levels are much more modest. So I think looking around that spectrum, mid caps US might be an attractive way to find some alpha in the portfolio when you might not be able to get it through beta and through an index term. And the other one would be maybe a bit more defensive stance on income-oriented strategies, especially in Europe, where I think the outlook is a bit less optimistic, unless something surprising happens. Let's say, some positive outcomes from the German and France elections, which I think are quite important next year to set the base for expectations for next year. But unless that happens, I think you be better off with a more defensive stance. And Europe is still quite attractive with regards to dividend payouts and income investing. So if I were to put a bit more defensive stance in my portfolio, it would be those areas where I have a high conviction.
Yeah, no, thank you for that. We actually interviewed Dan Roberts from your global income team. I used episode 27, I think it was. We
Yeah.
kind of pulled on a lot of those points in terms of income investing and kind of an underweight to the US and some overweights to Europe. So yeah, kind of an interesting one to go back to for listeners perhaps. Carsten, one last question, if I may, and I perhaps should have reordered these. I don't want to end on a kind of risk or kind of negative. But if there was one kind of element, one kind of concerning tail risk that you had at the moment, or something over the next 12 months that you're kind of looking to as an event which could be impactful, what was kind of keeping you up at night? What would be the biggest risk that you see?
I think the one thing where we have almost no way of trading for it or positioning for it is the geopolitical risk in many aspects, because it is playing for the last 3 to 4 years or so. It's playing a much bigger role in our thinking, and therefore I think you always have to think in scenarios. You cannot make one prediction or one positioning for the next year. You have to think in scenarios and their likelihoods, and therefore, you always have to, I think, imply some geopolitical risks, which is very hard in terms of how you play it in a portfolio. But I think if anything, um, the geopolitical risk could play out positively and negatively. Negatively, of course, you can easily come up with many ways of negative impacts. A more significant trade war between U.S. and China. The war being escalated, the Ukrainian war being escalated, or the Middle East situation getting out of hand, or things like that. But there could also be some positive influences, because if the war maybe in the Ukraine were to end, and this gets off the table, I think it would be a relief for many people. So geopolitics is some of the things that you almost, it's impossible to model, but you have to have it on the agenda. And elections, as I said, I think German and France elections are pretty critical next year as well. Um, because there's been some failure with regards to the governments, and there's a lot of hope, but the question if it comes to fruition going forward, for new governments to take the reins, and we would need it desperately in Europe, I think, to just always to position ourselves versus the big powers, US and China. I think a unified Europe would be a strong desire and a very good a precondition for things to going forward. But we're some way away from that, and there's a lot of hope involved in that. But you still cannot lose your optimism. So I'm hoping for the best to come.
Yeah, absolutely. Yeah. Carsten, thank you so much. It's been always really challenging kind of trying to summarize such a complicated topic, but I really appreciate you kind of going through things for us. It's been a really useful session. Thank you for that.
Thank you very much, Gordon, for the invitation. It was a pleasure, and I wish you all the best.
Thank you for listening to the Investor Insights podcast, hosted by Killick & Co. You can get in contact using our podcast email address, investorinsights@killick.com. For more information on any of the topics discussed, or for further details on the services offered by Killick & Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killick & Co. is authorised and regulated by the Financial Conduct Authority, the FCA.